Hi, I'm Bill St. Clair, shareholder here at St. Clair CPAs. And today we'd like to talk about three very key areas that don't have a lot to do with accounting, but have so much to do with your entire life cycle and personal wealth as well as family wealth. And that is getting ready for business succession. And then after you have business succession, what do you do with your money? Retirement planning. And then if you have retirement planning, how do you make sure the money stays in your family? That's called estate planning. These three things are so important in everyone's life. Whether you have a lot of money or you don't have a lot of money, it's still important to make sure that you go through this entire process and understand the things that are out there to help you. So the first step you do in business succession planning is what we do is we meet with the owner. We need to understand what we need to do for them. The most important thing is to understand their goals, their expectations. What do they expect? The most important thing that business owners have is somebody they can rely upon. They need to know that there's somebody in their corner to take good care of them and give them a proper path that they'll ultimately decide. So we give options, but at the end of the day, what do they want? What do they expect? What kind of money do they think they're going to get? What type of longevity do they still want to be in the business? Most important thing about business succession is to start planning this 3 to 5 years before you decide to leave the business. Because from a financial standpoint, having your documentation in order, having your financial statements and tax returns done properly will only enhance the value of your company. What do we do when we first get involved and after we come up with the scope of work for the owner and their goals and expectations? The next is the most important also. Information gathering and document review. This is what an outside buyer is going to rely upon. So what we do is we gather up the tax returns, the financial statements. What type of entity are you? Are there anything, road bumps, speed bumps in there that will take away the value? We try to address those items now. Make sure that your business is clean from a standpoint of a sale. And most importantly, making sure that you get the best presentation to your potential buyer. So we go through internal controls, your systems, your manuals, your employees, the key employees. How can the company operate without you, the business owner? So the most important thing is to make sure that this thing is a functioning cash flow entity so that the buyer wants and will pay you more money for because of that cash flow. They give you multiples based upon that cash flow. So it's so important to try to make sure that the bottom line becomes as strong as possible a few years out. That enhances your value for a sale. That leads to the most important thing of business valuations. The most business valuations are very subjective. They can be done whether it's a ballpark calculation between competition, friendly competition, where they both know the business, they know the industry, and they just will come up with a number. They can be done by existing buy-sell agreements, which was probably the weakest of the bunch, but important from a different angle for retirement planning. Um, Most importantly, they'll try to look at cash flow, as I mentioned earlier. They're going to look at your EBITDA, which is your earnings before interest and taxes and depreciation and amortization. That is the net cash flow of the company, and they'll give you a multiple on that. That's a very prominent way of valuing a company. You can also do internal revenue code valuations for internal buy-ins and buyouts of maybe key employees taking out an owner. And that way, it's a very more fluid way for number crunching and coming up with discounted cash flow and capitalization of earnings to give a value that the IRS would accept for any sort of internal shareholder buy-in, buyouts, or gift and estate planning purposes. So the business valuation is what you're going to be paid on. So important to make sure that you come up with the best possible light. As always, any business valuation is based upon a willing seller and a willing buyer. So if you don't have those two happening, the sale doesn't consummate. So make sure that you give yourself the best foot forward in negotiating a strong business valuation with a solid full business valuation report to back it up. So when you're talking to a potential suitor, you know it's going to look good. Lastly, and by no means the least important, is the actual business sale process. It's so important to have trusted advisors around you when you're doing this. You need your law firm to negotiate the agreements. You need your accounting firm to negotiate the numbers and the values. That's why we take such an active role in this, to try to get our clients the most money as possible. Because after this is what you're going to live on for your retirement and future earning streams. So the most important thing is gather your team around you, start strategic planning for the potential business sale. As I mentioned earlier, 3 to 5 years out is when you should start that, and keep looking at it on an annual basis to make sure that it's updated and done properly. Eliminate the road bumps that will decrease values. Make sure that you have the best value possible, and then you start strategically planning with your team for the agreements. What type of entity sale do you want to have? Will it be an asset purchase where you might not get the most advantageous tax advantages? Or the preferred methodology is always a capital gain, where you sell your stock or your partnership interest to an outside buyer, and the entity doesn't change much other than the ownership sale. Therefore, you're paying the least amount of tax under today's current laws. We can help in those areas, very much so. Even if it is an asset sale, there's structures and language to put into those asset purchase agreements in order to give you the largest portion of capital gain as possible, with a listing of the assets in the various categorizations that the willing buyer and willing seller will agree to. We try to help, and this is where we really can save you a lot of money from that tax savings angle, along with the valuation process and negotiating all the proper systems to allow you to gain the most. After you go through the strategic planning process, you're going to find potential suitors, potential buyers. What happens then? Due diligence. That's a fun part. And these buyers want to kick the tires and get to know your company inside out. And they will ask all kinds of questions, repetitive times, with an amazing amount of information of what they'll gather. So you need your legal team and your accounting team to really weather this storm in order to get you the number that you would like, and also to consummate and complete the deal. Due diligence isn't something to be afraid of, but it is tedious and time consuming. But ultimately, it leads to your settlement and very happy seller of your company. Next, we'll go into retirement planning after you get the proceeds from your business sale.